Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hello and welcome to Better System Trader episode number 115. Glad you could join us today for our chat about intelligent systems that maintain themselves. Sounds good, doesn't it? Well, actually that's not all we're going to discuss today. We've got so much more than that. Our guest for this episode is David Stendahl from Signal Trading Group. David is a CTA with more than 20 years of experience designing and trading systems, and not only is he an international speaker and the author of 4 books, but he also co-created the backtester in Tradestation many years ago. In this episode, he's got a lot to share with us. Here are just a couple of the points that we cover. Firstly, how to build intelligence into trading strategies so they dynamically adjust and maintain themselves over time. We also talk about the key to portfolio construction and the major factors to consider for effective diversification. David also explains why it can be better not to specialize in a particular market. And we also talk about the main drivers behind strategies that have lasted more than 10 years in the market. So let's get right into it now and head over to my chat with David. Hi David, welcome and thanks so much for joining us today.
Thanks, Andrew. I really appreciate it.
Now, I'm really excited to be talking with you today because we've got some really great stuff to discuss. But before we get into that, how about we start with a little bit of background on yourself? So can you kind of share with us a bit of background on how you got started in trading the markets?
Well, I started a long time ago where I was into stocks originally, quickly progressed to trading options just for myself. And I started developing systems back in the mid-90s. And ever since then, I've been sort of focused just on the future side. So, for a long time, it's just been trying to understand how I like to trade, systematizing it. And from that standpoint, I went through a process where automated a lot of different systems. And eventually, after trading for myself for a while, I traded for a couple of CTAs. And now I'm back on my own and beginning to dabble and start to trade for some other people, but that's in the early stages right now.
Yeah, okay. So your main focus now is the trading the futures markets?
Yeah, I found that, if you're going to spend a lot of time designing systems, maintaining the systems, analyzing the markets, going through all that stuff, that for me at least, I need the consistency that commodities and futures as a whole, obviously, sort of bring to the table. So I haven't done anything with stocks in a long time, and I've always found that futures are a little more reliable when it comes to designing systems.
Yeah, and do you gravitate to any particular styles of trading in the futures markets?
Well, I've got a couple of different styles. Obviously, I've been designing systems for a long time. So, of course, we got the trend trading type systems. Obviously, that's where you make, at least for myself, despite some of the markets now, but that's where a lot of the money's made. And then to offset the trend trading systems, I have a lot of I call them momentum, mean reversion type systems. And then I've got a number of pattern based systems, but everything is fully automated. There's no fundamentals that are involved, nothing outside, moon phases, anything of that nature. Everything is just straight open, high, low, close data and following those 3 different styles, the momentum, trend, and pattern based.
Yeah, okay. So you said you started off with stocks and you did some options work and then you kind of moved more into the systematic style a bit later on. So what kind of led you down the path of systematic trading?
Well, interesting story. I mean, for myself, I found that I would look at charts, when I was trading options and, back in the early stages, I would look at charts and as soon as I would make a decision, going long or short, whatever the case would be, I'd get into the trade and immediately I'd start to see things that I hadn't seen before. And I'd start to, oh my God, why did I get into that kind of a trade? And then, I did a lot of webinars and workshops with Mark Douglas, years later, but, kind of intuitively, I just found that I would look at the markets and I guess I could give a dissertation as to why you should be going long the market and flip a switch why you should be going short the market. So it would drive me crazy. So what I did was I said, just sit down, take the thoughts, the process that you would want to put into a system, and begin that process of designing it. And so I just simply found that specifically for futures trading, that became much easier. And for myself, it really forced me to really sort of sit down, understand what it is that I wanted to put into the system, and from that perspective, it's it's gone its own little path, with the evaluation and all the other things I've done over the years. But I've just simply found that that has helped me to sort of focus on my trading style or styles, and really has helped me to sort of concentrate on what's important to me.
Just digging into this designing of systems a little bit more, I think I read in an interview that you did for, perhaps it was Stocks and Commodities, I think many years ago, and you mentioned that you'd like to create intelligent systems. Can you kind of explain a little bit more on what that means? Like, what are intelligent systems?
Well, intelligent systems to me are, I guess there's twofold. One, I try to keep them simple, that the intelligent systems, people will put more and more code, more and more layers around their systems. And so one degree of intelligence was keeping them simple. It sounds silly, but that's the crux of it. The other thing is the tools and the indicators that go into the systems, they have to adjust themselves over time. So what I would find is that they would be dynamic, and we're not simply dealing with best example I can give to you is like RSI. Everyone pops it on the screen. Everyone looks at RSI. They all look at what's considered to be a high level or a low level, 80 being high, 20 being low. And I started making my indicators and eventually the system a little more intelligent, and that it was dictated what is considered to be a high level or a low level based upon recent events, as opposed to maintaining that 80-20 level. So you go into a bear market, and you're going to find that obviously the high level and low levels are different than what you'd have in a bull market. So what I meant by intelligent systems were those that had the ability to dynamically change and adjust to the environments that they were trading, and maintain the systems so that they were what I'll term as simplistic, so they didn't have a lot of moving parts to them. And therefore, I found that those quote unquote intelligent systems were able to sort of maintain themselves over the years.
Okay, so that approach of adapting, I guess, the period of look back on the RSI and the extremes to more recent market behaviors. Can you use that just on indicators, or is there other avenues that you can use this intelligent system approach?
Well, obviously with all the different styles, that you can always factor certain things into your systems that will allow them to sort of maintain themselves. Another example might be that we have environmental overlays that tell you when you are and are not allowed to trade, and those maintain themselves. So if you have a system that requires volatility, then we have a volatility overlay, and it will allow you to sort of adjust and allow you to trade only when it's in a volatile condition. You'll miss a little bit in the beginning phases, but you always make sure that the system is designed for a particular environment, and you're going to trade within that environment. And then as far as the intelligence, the maintenance of the systems, I do an awful lot with walk forward analyses, where I will take a system and allow it to adjust itself. I've got a whole set process that I go through, but nonetheless, it's something that will allow you to maintain the variable settings so that you always have something that's robust and stable, as opposed to maintaining the same variables, time in and time out.
Yeah, okay. So this intelligence is typically just applied to the entries, or can you use it on other components as well?
No, it's done either A, on the entry side. Obviously, you combine that with the exit side, and then a lot of it can be done on the scaling side of it, where you're continually adjusting things. And in certain environments, you might trade a little more aggressively based upon an environmental overlay, or you might trade a little more aggressively based upon seasonality, or I've written a couple of articles on like maximum favorable excursion, where you're looking at the individual system and you're just simply adjusting and the scaling of positions and position sizing. So it works both for the entry, the exits, and then everything in between, as far as how aggressive you want to trade in that environment.
Yeah. Okay, cool. All right, thanks. Well, I just wanted to kind of switch gears a little bit into portfolio construction and diversification. Now, at the start, you mentioned that you diversify across different styles and in different markets. So, what's your main idea or your main approach to diversification and portfolio construction?
Well, a lot of it's going to come down to I guess understanding the individual systems and then combining those together so that you're not either A, having a lot of correlation between the different styles. And what I do is, because I have, I don't know, it's close to 400 systems or so, that what I'm trying to do is when I create the portfolios, I have software that I've created over the years that I don't sell, but I just use internally, that will combine different systems together. And what I'm attempting to do is to minimize it's the drawdown side of it. It's not just maximum drawdown. It's something I call underwater volume index, and so UVI. And what you're trying to do is to make sure that you're combining different styles together in order to construct a portfolio that's going to be robust over time. Each system is going to be robust over time. Second, you're not overemphasizing systems that are all going to pile on at the same time. I'm just the opposite, where if they're trading at the same time or basically in the same vicinity, what I'll do is I'll take them out, because what they're going to do is that they're going to show metrics for the portfolio that are going to be much more dramatic. And obviously, they're going to have bad drawdown metrics. And so what I'm always trying to do is to combine systems together that are I guess non-correlated as far as their equity curves go. And I've always found that as long as you've got lots of systems to select from, it's relatively easy to construct a portfolio that's a little more stable, if you will, over time. And it's the real key is just not overemphasizing a particular style. It's nice, steady, consistent systems, and not emphasizing too many systems to trade at one particular time. That's where you blow up.
So those 400 systems that you've got there, they obviously don't trade at the same time, but are you saying that some switch on based on market conditions and some switch off, that kind of thing?
Exactly. So, what you'll have is, the environmental overlays will prevent systems from trading simultaneously, and there's going to be some overlap. But when you have, pattern-based systems and momentum and the trend, I've always found that the pattern-based systems kind of begin at the end of the trend, so that you come into you're at the final stages of bear phase. The pattern systems start to trigger. Then the momentum systems will trigger. Then you got the trend systems and a little more momentum, a little more pattern. So there's a little bit of an overlap, but not a lot.
Yeah. So how far do you think traders really need to diversify, though? Is there kind of a limit to the number of systems that you need to make, I guess, an efficient diversification?
Yeah, without a doubt, you don't need that many systems per se. But what I would say is that you do want to diversify over time. So in my particular case, it's like 45 minutes up to 240-minute bar systems, and a couple of daily and a couple of weeklies, and then diversification through the individual markets. So I do an awful lot with correlations between markets, and just simply looking at their the way that they actually operate and the way that they move. And what we're trying to do is to find those systems that have consistent non-correlation or near zero correlation between them. And it's not to say that you can't be on the wrong side, long or short, but for all intents and purposes, what will happen is that you combine maybe 3 or 4 markets that are, for the most part, non-correlated. Combine that with multiple trading styles, multiple time frames. Put all that together, and you can have maybe 3 markets and maybe 4 or 5 systems. And I think that's good for the average Joe that's actually out there.
Okay, that's interesting that you've got kind of multiple layers of correlation there. So you're looking at the markets and then the strategies over the top of that as well. Correlations change over time.
Yep.
So how often do you measure correlation? Is that something that you do quite often to adjust your portfolio?
Yeah, what I do, at least on my website, I've got, and it takes a long time to run these types of numbers, but it's a 40 by 40 grid. I do it both on a weekly and on a monthly based data. I don't do it on daily because it changes too frequently. So what I'll focus on are weekly bars and monthly bars. And then what will happen is you can see those markets that offer up consistency when I do a rolling correlation, that you can see those markets that offer up a consistent near zero correlation. Obviously, we both know that you're going to have the ebb and the flow of the correlation between the two markets. But if the ebb and the flow, the high point and the low point, are still in and around the zero mark, and they're able to have that type of consistency over time, then it's a good market to include. So, perfect example, and a lot of people wouldn't trade this market, but if you trade the S&P 500, a market that offers up really good non-correlation, just market to market, is lean hogs. It's not the most liquid market, granted, but it's still a really good, consistent market that offers up some advantages. And, obviously gold and 10-year notes are some other ones, but I have a list of the markets that offer up nice, consistent stability against individual markets and then across a myriad of other types of markets. You're also looking for consistency across, one market against 40 other markets. If it can have consistency across all of the markets, then that's still a perfectly good market to be trading, including in a traditional portfolio.
Yeah, okay. Now, what about for traders perhaps who only have a very small number of strategies, or maybe one or two, and they're looking to diversify? You've mentioned a couple of ways to diversify across timeframes. You could have strategies in same markets or across different markets. Do you think there is one particular avenue that holds more potential for the trader who's looking to build more strategies than perhaps the other kind of diversification techniques?
I've found that a lot of people are. It's not derogatory, but they're one-trick ponies. They seem to focus on one individual market, and then they'll say, "Well, I'm diversified because I trade the S&P and I trade the Dow or the Nasdaq." And I'm saying, "Well, that to me is the same market." So I guess what I would be saying is that as far as a simple way of going about doing it is to look at the different time frames and sort of drill down into the market, and you'll get some diversification across time. For myself, and I'm sure for yourself as well, that being systematic and being able to watch lots of different types of markets, I think the better way to do it is to be able to analyze the different markets, as I was talking about with the correlation, and go the direction of honestly just simply trying to trade totally different markets, understand their personality type, and from that standpoint, making sure that it kind of matches your personality type and the styles that you like to trade. And from that standpoint, that's the key of the diversification. I'm not big into offsetting the risk and trying to diversify myself off of spread trading and things of that nature. I've never gone that direction myself, so I keep it simple with time frames, different markets, and different trading styles.
Yep. Okay. Awesome. Thanks, David. Now, I just wanted to ask you. Back to the interview that I read, I think it was in Stocks and Commodities, might have been about 2004, so quite a long time ago. I've got a little quote here that I want to read to you, and then I'll ask you about it. Hopefully you can remember this. It was a long time ago. You said, "I'm trading the same systems today as I will 10 years from now because my systems have dynamic qualities." Now, obviously, I think that was 13 years ago, and with the benefit of hindsight, it's easy to talk about this kind of stuff. But are you still trading those types of systems now or not?
No, actually, I am. I started a CTA back in 2001. 2001, 2002, something of that nature. And I brought a number of systems to that CTA, Commodity Trading Advisory Firm. And those systems that we had that we were trading, I've made some modifications, but for the most part, it's a lot of the same styles, the same systems, the same premise, if you will. The things that have changed has been those things that like environmental overlays that prevent you from trading from certain times, but the system itself, the core to the system, are in fact the same. And obviously, with some of the ways I go about adjusting the systems, monitoring the systems, and adjusting them through my robustness testing through Walk Forward, the variables will change ever so slightly. But if I have a system that needs to adjust dramatically, then it gets a low weighting, gets tossed out of the portfolio. Those systems that remain fairly steady, their variables don't really adjust too frequently, then those are the ones that I've been able to maintain for a long time. So I would suspect that obviously the markets are forever evolving and changing and whatnot, but the commodities, for the most part, have maintained themselves. Those that were, big trending markets, maybe they're not the big trenders that they used to be, but they're still markets that pop up every so often. Look at cotton as an example. That can run hot and cold, just as it did back in the early 2000s. So to answer that question, yeah, I'm still using virtually the same systems with very small adjustments, but that's the way that it's worked for me.
So do you have any kind of idea or why those strategies are still working? I mean, you mentioned that they're based on a sound premise. They've got dynamic qualities. You use walk forward analysis. You've added these market type of filters, but all of those could, I guess, impact the strategies over time. But do you have any kind of idea on what could be the main driver there, or do you think it's all combined to create a longevity in these strategies?
Well, I think that the simplicity of the systems, at their raw essence, obviously a breakout-oriented type system, it still works today. There's still a lot of volatility. Perhaps I know that there's more volatility in certain markets, but that same premise, it still works. It's not the systems have their own twists to them, but they still work. Divergences still work. You can have accelerators where the market has a major surge. And volatility is your best friend in that particular instance. That the same is today as it was back then. The difference being is that perhaps there definitely is a little more volatility in certain markets, but if you look at a lot of the futures markets that I trade, all of the I'll term the general more liquid markets, news items still affect them in the same way that they did back then. I'm not talking about going back, 40 years, to that time frame, but with the increase in volatility that's been from my perspective applied to my systems has been the only thing that's really adjusted, and the systems have been able to maintain that because most of the time they're looking for that kind of volatility. So it certainly hasn't hurt me over the last 10 years.
Yeah, and what about the strategies that kind of haven't made it over the long term? What have you learnt by seeing the performance of those strategies kind of die?
Well, I found that they themselves have died because they haven't maintained the degree of consistency that I've always been looking for. So you have certain, systems that for whatever reason, just have failed. And what will happen, at least on my side, because I'm constantly monitoring my systems, and I have these tools that I use to give them a grading, if you will, A, B, C, D, failure. And I've just simply found that with all honesty, those systems that have failed over the years have been the ones that I put a lot of emphasis to. I put a lot of time and energy, a lot of coding effort into it, and I made them super complex. Right. And I'm telling you straight out that the systems that have been the most stable and consistent and better performers are those that really at their core are overly simplistic. They don't have a lot of moving parts. They just simply do their deal. And I'll say this, that over the years, I've done a lot with evaluating systems and developed a lot of software for building portfolios, and I've just simply become realistic in my expectations for systems. And I think that's been the kicker for myself, that I often tell the story that I started off with simple systems because I didn't know any better, and then I became really smart and threw everything in the kitchen sink into my systems, and then I got even smarter and legitimately made the system more simplistic again.
Yeah.
And that's been the key. And the difference is, when I evaluate the systems and the expectations I have for those systems, I'm very realistic. I can have systems that can trudge along and make good money for a period of time, and then they can go dormant sometimes, where you're losing money over a month or so, and then they pick up again. Most people would throw the system aside and develop something a little bit different. I've always found that if you evaluate the system correctly and you do your due diligence on the robustness, and you have realistic expectations for them, because you know that you're going to be combining it with other systems and other markets and other timeframes, that's where you're more willing to hold on to those simplistic systems, and those are the ones that I've always found that have been the more stable over time. So the complex systems are the ones that I wasted time on and I've tossed out, and the simple systems are the ones that have maintained themselves.
Yeah, okay. Awesome. All right, thanks, David. Now, I just want to ask one final question before we start wrapping up for today. Now, as you mentioned, you've done some work with Mark Douglas in the past, and so I wanted to ask you about something that a lot of traders kind of struggle with, especially at the beginning, is finding that a particular type of trading style or strategy that matches their personality, and so can become very hard for them to trade that type of thing. So how do you think traders should go about trying to match their personalities to trading strategies?
Well, that's why, with Mark Douglas, unfortunately he passed away a while ago, a couple of years ago, I think it was. But he and I, in fact, we came down your way. We made it to New Zealand doing some presentations. Yeah. But he would start off by talking about the psychology of trading, and then people would start asking, but specifically, how do you do it? And then he'd point to me, and I would come in and I do the second presentation, which was evaluating the system. So I co-created the backtester that's inside of Tradestation, did that back in the mid-90s. Yeah. And the whole premise of that report, at least the ones that we created, was to go through and truly evaluate the system, from a lot of risk reward metrics, looking for consistency and, the longevity of, series of trades, looking at the consistency of the averages, looking at, different tools, different charts that kind of give you a footprint as to what kind of a market, what kind of a system you're actually dealing with. And I guess it really comes down to, if you have a system and you go through the evaluation process, that you're going to be looking not to maximize profitability. You want to look for consistency over time. So the way that you manage that is to not run an optimization and try to make the most money. You want to focus on, just to answer your question, focus on a lot of the risk reward metrics. So at least inside of Tradestation, you've got return retracement ratio, and I can't remember the calculation, but it's better than that of like the Sharpe ratio, the RENA index, which is the firm that I was associated with, where we have a risk, a reward, and a time component in that kind of a formula. If you focus on the risk rewards and you don't focus on just straight out profitability, then I think you'll do much, much better. And it's just a matter of just looking at the consistency of the equity curve and just being just smart about this, that if you're a conservative trader and you don't want volatility and you see excess volatility in the real-time performance going forward, or obviously the historical back testing of the system, it's not going to fit with you. You're not going to feel comfortable. So you have to look at, obviously, drawdown, which is what everyone looks at, but the largest drawdown. Look at the consecutive losses. After consecutive losses, what was the next trade, the next winning trade that ended that? And slowly over time, you'll get an idea as to the personality of the actual system. I can go on and on. I used to do 3-day seminars just talking about the Tradestation report and the nuances to some of the numbers and some of the formulas and obviously some of the charts that were in there. But you're really going to be looking for something that matches your personality. So if you're aggressive, you're going to be bored by essentially my trading style, which is looking for consistency. And if you're a conservative trader, conservative futures trader, which is not an oxymoron, but you really are a conservative trader, and that's kind of where I put myself. You're going to gravitate towards the consistent systems, and you're going to avoid those not markets, but those systems that are ultra aggressive. And a lot of it just simply comes down to just looking through that big report. It's multiple pages long, and just kind of focusing on certain numbers, those that would tell you what is consistent, what is not. And from that standpoint, it's a long, laborious process you have to go through, but it's certainly time well spent rather than tossing in a system after having spent a lot of time on it, or going out of business because you blew up because you had too aggressive a system. In that particular instance, I think that might really help. And then the final thing would be just making sure you've got enough capital to be able to weather the performance going forward in real time. So even though the drawdown says X, whatever that is, you've got to anticipate that the performance going forward, short term or long term, it's not going to be the same. It's ever evolving. Sometimes it'll be better, but in many cases it's not. And you forget about commissions and slippage is what a lot of people do, and then they're surprised going forward. But once you have a system that you have thoroughly tested and you feel comfortable with it, give it an opportunity to prove itself, and don't toss it out when the first system or the first trade turns out to be a loser, because inevitably that's what's going to happen. You really have to stick with the actual system, and that was one of the key points that Mark Douglas would always talk about when you're going through the psychology, the pros and cons of a system, and getting over the hump. It's truly just understanding that you have to give it enough trades to really feel comfortable with from that side.
I think you touched on a really good point in there as well. When you look at a backtest report and you see a drawdown of X amount, you don't really get any emotional attachment to that. You don't really feel the pain. Whereas when you're trading it, can you handle X number of losses in a row? Can you handle X months of waiting in drawdown before you make a new equity high? So I think really delving into the reports there and understanding, not just the figure, the maximum drawdown figure, but the kind of the conditions around that and the process that you could go through when you have to trade through that. And is that something that you personally can handle? I think that's a really good point you made there.
Yeah, that when I would do these workshops, I would ask a person, would you rather have a system that has a 10% drawdown or a 12% drawdown? And of course they're going to say, I'd rather have the 10% drawdown. But then when you look at the personality of the system and you look at some of the charts, we were one of the first ones to put the underwater equity curve in there, and maximum drawdown of 12 might actually be better because it was short, it was violent, and it recovered very quickly, as opposed to a 3 or 4 year drawdown where its maximum was 10% and you recover, but it took years to recover. So a lot of people, as you were mentioning, will look at certain numbers and they're really not taking the time to really understand what these numbers represent. And they're just looking at it from a historical standpoint. But when you start trading it for real, then you would appreciate, having looked at the underwater equity curve and realizing that, the 12% drawdown, although more painful, but it recovered much quicker. In that particular instance, you might want to look at things from a slightly different perspective. And I think that certain individuals, when they first start off, they just simply look at some key numbers. They look at the simple numbers and they go, yep, that works for me. And then they're gone in 3 trades. Take your time. Every number we put into that report was there for a particular reason. And if you go through and really study that report and understand the difference between what I'll term as a legitimate system and a piece of crap that has great numbers, but there's absolutely no way that it has any consistency to it, and you start comparing those different reports, I think that what you'll find is that the more you study those things, you'll get a better feel for the personality of that particular system. And even if you have a really good system, if its personality doesn't fit yours, where it's way too aggressive, you're not going to trade it, and you're not going to trade it correctly. You're not going to trade it for a long period of time. Just set it to the side, put it in the bank, wait till your account grows, you evolve, you change, whatever the case will be. And that's why, for myself, I've got so many systems that I always have something that is theoretically going to work at one particular time. But I have the ability to constantly test these types of systems, and certain systems come back into the fold and others, stay in the bank for a long time. Yeah. And my best advice to people is study the report. It's there for a reason, if you're on Tradestation, obviously, but it's there for a reason so that a person can feel comfortable that they're understanding that particular system.
Yeah, excellent. Thank you, David. Now, I'd just like to start wrapping up with some quick closing questions.
Sure.
The first one, what's the biggest lesson you've learned through trading?
For myself, it's stick with the system. If it's legit and you've spent the time to evaluate it and spent a lot of time to design the system, give it time, meaning 10, 15 trades, so that the hard work you put into the system, you have the opportunity to pay out. And if it didn't evaluate well, then obviously you wouldn't be trading it. But if you're going to trade it, stick with the system. And my little phrase is, trade without ego, no emotion, no greed, no opinion. Follow the system and give it enough time to be able to prove itself worthy.
Yep. This question is probably a little bit related, actually. What do you think is the most important ingredient to becoming a successful trader?
Having enough capital to trade correctly. And it's probably just finding the right markets, the right personality to really fit with yourself. And so, from that perspective, I find a lot of people, they jump in, they don't even understand their market, and the volatility associated with it, let alone having applied a system and not having done the evaluation. So I guess, do your homework and understand yourself, and always realize that you control the trading. If you don't feel 100% comfortable with it, put it to the side until you do feel comfortable, and make sure you always start off with enough capital to be able to weather any type of a legitimate drawdown.
All right, and do you have any favorite trading books?
Well, I mentioned obviously Mark Douglas, so The Disciplined Trader. Yep. Looking at my library of books up on my website, I have every book that I have in my library. So I'd say, let's see, there's the Koval, Mike Koval. He's got with Trend Following.
Yep.
A lot of the books that I like are, they kind of show you what they're doing, or at least go into some type of description. So there's a ton of books that are out there that will kind of do that. And the only one that really comes to mind is Suri, I always foul up his name, Dudeli. He's got a book that is, it's called Trade Chart Patterns Like the Pros. Excellent book because it goes through and shows different types of patterns. So you've got kind of the history of trend following and the pros and cons. You got the psychology, and you've got an example of a book that takes you step by step as to what some of these different patterns that we trade.
Yeah. Okay. All right. And what's the best way for listeners to get in touch with you or to learn more from you?
Well, you can go to the website, Signal Trading Group. And if you do have questions, I love talking about the market. So shoot me an email, which would be D Stendahl, my last name, at sigtg.com, short for Signal Trading Group, SigTG, and or follow me on Twitter, which is where I have and post a lot of information, 20 some odd tweets, maybe 30 tweets a day, just constantly talking about the markets. And you can follow me on Twitter at David_Stendahl. And from that standpoint, if you have a question, I'm more than willing to answer them.
Awesome. All right. I'll make sure I've got some links to all those up on the show notes page so people can find those easily. So thanks so much for your time today, David. It was really great having a chat with you. So is there anything else that you'd like to mention before we finish up?
No, I appreciate the conversation. Anytime I can talk about trading, it's always always a good time. I'm here in Cincinnati, Ohio, and not a lot of traders around. So that's part of the reason I like doing interviews and doing workshops, because it gives me an opportunity to talk.
Yeah, awesome. All right, well, thank you very much again, David. It was really great chatting to you, and I wish you all the best.
Great. Thanks so much, Andrew.
Cheers.
Appreciate it.
Bye-bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.